afternoon, everybody. It's a bit weird starting a presentation in this new world that we live in. You can't see anybody sitting down and the audience gathered and all of that. So sometimes you feel a bit mad, like you're talking to yourself. And even as I'm speaking now, I'm just wondering if anybody can actually hear me or if I'm making sense. But anyway, this is the world that we live in now. It is 4 o'clock, and we did say that we were going to start at 4 o'clock, and I see the number of participants is rapidly increasing. So I think let's start this afternoon's presentation. I think firstly, on behalf of GM Investments, big thank you to all our clients who have given up their time to join us this afternoon. We understand that your time is valuable, and we are eating into family time a bit. So we will do our best to honor the time commitment. We also want to say thank you to the two teams from Secutec and Westbrook who will be presenting this afternoon. Both companies have supported GM Investments in terms of our education initiatives, and whenever we have client presentations, they've always been there to assist us. So we're looking forward to the presentations from both companies. What I would like to do before I hand over to Jonty at Secutec is just take a step back quickly and look at the issue of tax-efficient investing. The reason I'm doing that is typically when you think of Section 12J, a lot of the interest and a lot of the excitement around 12J has to do with the tax deduction that comes from a 12J investment. And in fact, the marketing around 12J centers largely on the tax deduction. So I just want to take a broader look at tax-efficient investing, just from an advisor's perspective. And then I want to look specifically at 12J within that broad context. So just going to the next slide, Cyril. I think just a reminder. From a tax mitigation perspective, I think just a reminder of all the taxes that you pay as an individual. So just to remember all the taxes that you pay, we use the acronym credits. We should spell it with a double D. So C stands for capital gains tax. Typically, your capital gains tax is for an individual at maximum rate of 18%, for a company 36%. Retirement funds taxes, when you retire, when you withdraw from your pension fund, those would apply at that stage. Estate duty, when you pass on. And then dividends tax, and the other D would be donations tax. Dividends tax at a flat 20%, and donations tax also at a flat 20% above the first 100,000 Rand. Income tax, which I think is where most people tend to focus their tax mitigation efforts, and because that's the one we're most familiar with, it's the tax that we bump into most often. And then transfer duty for those of you buying property, and those of you trading in shares would incur securities transfers tax. So those are the different taxes that we typically pay, and it's the income tax number, which is the big scary one, that we generally try and mitigate. I think the important thing when thinking about various options is to understand that those options tend to have different impact on those different taxes. So if you look at a retirement annuity, you'll see the retirement annuity from a CGT perspective, estate duty perspective, dividends tax, income tax perspective, retirement annuities are fantastic. Obviously, there's a retirement funds tax implication that goes with that. But as you look at all the other different products, you'll see, for example, tax-free savings account, fantastic from a CGT and dividends tax perspective, not so great in terms of mitigating income tax or estate duty. And 12J at the bottom, well, from a CGT perspective, there's no benefit there, or estate duty, limited dividends tax benefit, and fantastic from an income tax mitigation perspective. So I think it's important to remember that in running away from one tax, we shouldn't run headfirst into another tax and create other issues for ourselves. So when it comes from a planning perspective, it's always important that we understand your tax situation and which taxes we're trying to mitigate. I think the reason that we are looking at Section 12J today in particular, but why we do pay attention to tax incentivized investing in the first place is that you can use these tax incentives to build wealth. And this is just an example of a client that we invested for in 2017, where the client invested in one of the 12J investments, an amount of 250,000, submitted her tax return in July, got a refund from SARS of 102,500, which was then invested into a retirement annuity. Following year, got a refund on that particular retirement annuity of 42,025 rand. So that single investment of 250,000 rand created an asset or grew a balance sheet by 394,000. So an increase in value of 57% just from harnessing the tax savings and incentives to be had from different investments. So certainly worthwhile paying attention to that. If we go to the next slide, when we start talking Section 12J, the other important consideration that one needs to have is the fact that we are talking about an alternative investment strategy, and we need to understand just kind of alternative strategies in general. Why would one consider undertaking an alternative strategy? So when we consider 12J, I think the first time I looked at a 12J investment was in 2012. The tax incentive wasn't great, in that you got an incentive and you had to pay it back 5 years later. But the other thing we noticed was that the investment that you had to put your money into, those investments were typically very high risk, typically venture capital type investments. So, when you consider venture capital type investments, typically there's a chance you can make an incredible return, but there's also a fairly decent chance that you could lose all your money. And, we weren't kind of happy with that payoff profile for our clients. So, and the tax incentive wasn't great either at that point. So we didn't really venture into 12J. However, at the moment, we are seeing much better products. So since 2014, when Section 12J was reviewed, we're seeing much better product development coming out of different 12J providers. So why would you consider alternative strategies? Certainly, there's a diversification benefit. They tend to perform very differently to the market and your traditional investments. They tend to be inefficient markets in that, typically we know what's happening with the markets of companies that are listed on the JSE. So those companies are researched, and lots of fund managers understand those companies very well. So there's a high level of efficiency in terms of new information being reflected in prices. In the alternative space, there's a bit of a premium to pick up by investing in those inefficient markets that perhaps fewer people are talking about. They tend to be a good inflation hedge, and they tend to give you exposures to opportunities that you cannot get from traditional investments. And we'll see those with the two managers that we're talking to later. Just the flip side of investing in alternative strategies is the issue of, sorry, if you can go back one slide, Cyril, is the issue of transparency and valuation. That tends to be a challenge. JSE, everything is listed. You can see the price. You can see the volumes going through there. In the alternative space, transparency is an issue. Liquidity is an issue. And certainly they tend to be a lot more expensive than traditional investments. So if we go on to the next slide. So our approach to alternative investing as GM Investments. So we understand the downside and the upside and how we mitigate. Well, firstly, from a philosophical perspective, we do believe that alternative investments can add meaningful value to a client portfolio. From a risk management perspective, we tend to allocate 5 to 10% of a client portfolio into alternative strategies, depending on the client's objectives and depending on the client's, risk profile. We are aware of costs, so we do understand that they tend to be more expensive. So we highlight that to clients, but they need to understand that there's very little that can be done to mitigate expenses in the alternative space. Just some of the product providers we use. What we tend to do is limit ourselves to the more established, well-known players in the various alternative spaces. So it's also a risk mitigation step. So in the hedge fund space, some of you are invested in Obsidian and 361. We're talking 12J today, so we'll be listening to Westbrook and Joltec, two of the biggest players in that sector. The private equity side, we've used All Mutual in the past. And, for those that qualify the BE shares, Equity Express is a platform there. And then structured products, the likes of AIMS and Investec. AIMS being part of ABSA. So we tend to spend a lot of time with the product providers, getting to understand their products, their costing, their strategies, but we put very few on the table in front of our clients. So if we look at 12J quickly, if you're wondering where 12J comes from, it's Section 12J of the Income Tax Act. So you can go to the Act and find Section 12 and read that particular subsection. Essentially, individuals, trusts, and companies may invest and write off 100% of their investment against their taxable income in the year that they invest. Okay, so you get a full deduction against taxable income to the value of your investment. As of, I think it was last year or the year before, your tax deductions capped at $2.5 million for an individual, and for a company at $5 million. The 12J provider needs to remain fully compliant with the criteria set out in Section 12J to ensure that you keep your deduction. I think this is a critical issue that when choosing a 12J provider, to remember that you've got to make sure that the provider will be able to remain fully compliant and invest within the required term. There's a minimum investment term of 5 years, but I think it's critical that clients are prepared to sit in these products for longer than 5 years. These are not endowment products that with a 5-year term where there's a fairly orderly exit after 5 years. You are buying a share in a company, and at the end of that 5-year term, those shares need to be sold in order for you to realize your value. So that may be orderly, it may not. It's important to interrogate the exit strategy as well. And I think important to remember is that the full proceeds from the 12J investment is subject to CGT. So if you invest R1 million and the investment doesn't work out and you only get, say, 900,000 Rand back, that full 900,000 is subject to capital gains tax. So with 12J, you're essentially swapping income tax or capital gains tax, and you're delaying it for a minimum period of 5 years. And then finally, there's potentially a sunset clause later this year. Hopefully, someone from the, maybe Dino or one of the other guys can give us an update in their presentation regarding that sunset clause, whether they think government will extend the sunset clause. So this may very well be your last opportunity to invest in 12J, or at least a month or so before the sunset clause comes into effect. One of our first clients that we invested in 12J, this has been his particular experience. So a high income client, they invested 250,000, got the tax deduction. So his capital at risk is 137,500. So far, he's got about 44,000 back in dividends, meaning that of his initial investment, only 37% of his investment is at risk 4 years later. So we've been quite happy that the products and the product providers that we've worked with have largely delivered. That investment currently has a net asset value of 237,000. So it would have to be a pretty calamitous result for him to lose with this particular investment, seeing as he's gotten 63% of the investment back already. But we're quite confident that the providers have put together pretty solid 12J products that we can put clients into. So just very briefly, our concerns around 12J. Remember, I'm presenting what I call a warts and all presentation. It's not our job to sell 12J to clients. It's our job to make sure that clients are informed. And with every product, there's the pros and the cons, the good and the bad. And we're just presenting our assessment of 12J. So what we don't like, our concerns, is that the marketing pitch tends to focus on the tax deduction. What this does is it does distract from the fact that there needs to be an investment thesis behind the investment which makes sense. And typically, a lot of the marketing material we get, we don't see enough about the investment thesis and the investment case. A breach of 12J by a fund manager could result in SARS levying penalties. So the choice of manager is critical. As we've said, there is a cost impact. It is higher than the cost of traditional investment, so it's important that you understand those costs. And then also, there is aggressive use of the tax deduction in calculating potential returns. So on the next slide, you'll see that for the same investment, if your tax rate's 45%, your IRR from an investment, particular 12J investment, is 16% per annum. But if you pay tax at the lower rate from the same investment, you make only 11% per annum at a 30% income tax rate. So the focus and a lot of the marketing tends to be on the 16% guaranteed rate. But it's important to understand that your personal tax situation does impact the return outcome. And then finally, the exit strategy. I've mentioned this before, so it's not an orderly 5-year investment endowment. You are buying shares in a company and you are taking on the risk that comes with buying shares in a company. So rather factor in a term of 6, 7, 8 years. So when you're considering, will I need these funds in 5 years' time? The answer is a definite yes. Then perhaps 12J is not for you, unless you are highly confident in the exit strategy that's being presented. So prepare yourself sort of mentally for a longer than a 5-year term when it comes to 12J. And then I think this is my last slide. It's not only about tax. When choosing an investment product and when mitigating against tax, there are other issues that we need to consider, like flexibility, liquidity. Some people want control over their investments. You're looking for income. The issue of divisibility. You invest $1 million, but you only want to take 100,000 out because you need it, whatever the case may be. And then also the issue of tax efficiency. It's important that we understand the full client picture in order to then give advice around the various products. Yes, there's the tax efficiency, but for some people, as they're discovering, liquidity can be a critical issue at some times. Flexibility can be a critical issue at other times. Divisibility or the ability to generate income. Those are all other factors that we do need to consider. So it's not only about the tax. Okay, so I think that's my presentation. I'm not going to take any questions at this stage because I do want to get the product providers talking. I'm going to introduce at this stage Jonty from Caltech. Jonty is an admitted attorney of the High Court, Jonty, and I think he did your articles at Edwin Nathans, and now finds himself in the money management field. So, Jonty, over to you. Our agreement was 30 minutes, so I'm going to ask you to try and stick to that, please. So, thank you very much for your time.
Greg, thanks for the opportunity. Good afternoon, everyone. As Craig mentioned, my name is Jonty Sachs. I'm one of the partners at Caltech. Although I am an attorney and not very good at maths, my two partners are both actuaries and have been in the financial world for many, many years. At Caltech, we are alternative investment fund managers. Section 12J is just one of the types of investments that we manage, but we are the second largest in the market, and I can confidently say that we are one of the, if not the, top performing Section 12J fund manager. But you'll see that for yourself. We are presenting 3 Section 12J funds. We're presenting Auric Capital, Infinity Anchor Fund, and Zimbali Capital. So without wasting any further time, I'd like to introduce you to Pablo Fatides. Pablo is the resident entrepreneur on Bruce Whitfield's show on a Thursday night. He's an SME expert, and he's the CEO and co-founder of Auric Business Accelerator. I'm sure you've heard him on 702 or Cape Talk. Pablo, over to you. Please give us a bit of background into you and into Auric Capital.
Wonderful. Thanks, Jonty. Let me see my times. Time is tight. Welcome, everybody. Thank you very much for having us. Thank you for spending some time to listen and learn a little more around the fund that we have created. I'm going to share a slide presentation with you to take you through the fund itself. I'm confirming that everyone can see this. If not, please shout. Thank you. So Auric Capital is a joint venture between Auric Investment Holdings and Caltech. We started the fund as a business that is underpinned by Auric Business Accelerator. And Auric Business Accelerator is a business that has now been in existence for 15 years and provides customized growth services, business growth services to SMEs right around the country. We have offices in the Western Cape and offices in Gauteng, and we carry in and around 450 odd live clients. We have clients also in the SME space in the United States, in Europe, and in the UK. The fund itself is an SME fund. We define an SME as a privately owned business, typically doing annual revenues above 15 million rands a year and below 300 million rands a year. There are about 45,000 such businesses in South Africa. That's the addressable market. These businesses are largely exit-focused. The average age of the business owners that we work with in these businesses is 49 years of age. And you yourselves would know that as you approach the magic 50 number, that's when people start waking up to saving for the future. And in fact, most wealth management businesses globally start to really market actively to potential clients as they approach their mid-40s in order to scale up opportunities with them. It's no different in a business. When a business is being built, up until about your mid-40s or so, as a business owner, your mindset is entirely focused around income. And as you start approaching 50, what we have found, not only here but globally, is that most business owners start saying, well, what's the end game? How do I migrate my business and change my behavior to build a business that not only generates income, but will generate a capital exit for me? It is the nature of this business owner to be deeply invested in their business. In fact, most of the investment that they had available has gone back into the business. So they carry the bulk of their wealth in the well-being of the business itself. And that's where the shift of focus takes place that brings them into Auric Business Accelerator. We have about 300 SMEs that fit that 15 to 300 million rand annual turnover range. And last year, up until February 2020, the average compound growth rate across that portfolio in revenues was 28.9% in a country whose economy grew at under 1%, in fact 0.7%. We believe we will close off our books this year with an average compound growth rate, given the year of COVID behind us, across that portfolio at between 22 and 25%. We invest from an Auric Capital point of view only into growth momentum. So not a story about growth, not for growth, not for startup, because we don't work with startups, not for rehabilitation or survival as a result of COVID, but where growth is already in place that we can witness in the Auric Business Accelerator portfolio. We have an opportunity to invest in those particular businesses to maintain their growth momentum. We also have a very active process of post-deal management. In that, once we have made an investment into a business, we have got facilitators that work with those businesses 3 times a month, ensuring that they are meeting their performance requirements, evaluating risk, and providing additional support to ensure that they do hit targets. Our target is to deploy all our capital within the next 6 months post-February. We, at the moment, have around 48 million rands worth of demand for funding in businesses that sit within the Auric Accelerator environment that meet what we refer to as a fundability measure. We calculate in each of those businesses 29 points of data, and using various algorithms, we're able to assess the fundability index of a business. Only when the fundability index is there and the scale and growth measures are in place do we invite those businesses to apply for equity funding in order to maintain and support their growth momentum. Very briefly, the Auric Capital's pipeline enablement is a distinguishing feature for us. As mentioned, we have 2 accelerators that operate nationally. At the moment, they are serving around 430 SMEs, cross-sector, cross-industry, doing more than 15 million a year, up to 300 million a year with growth services. They can only apply for the funding after 6 months of having been in the accelerator. When you invest in SMEs, it's essential that firstly, in the investment, you're working with accurate data. Over the first 6-month period, we restructure income statements and balance sheets. We clean up the numbers. We start to identify the 29 points of data that we're going to be tracking to ensure that we're delivering growth support to that business owner. Plus, we collect extensive behavioral traits and evidence of behavior. In other words, aptitude and personality of the business owners. In an SME environment, the mindset, the attitude, the behavior of the leadership team is absolutely essential. After 6 months, we have both sets of data available. We invite those businesses, should they want growth funding in order to maintain their growth momentum, to come through to Auric Capital. There they present to an Investcom committee, which is structured very differently. The Investcom committee over there looks for 2 elements only: risk and exit ability. It is essential that when we make an investment in an SME, we have thought through how to harvest that investment and exit the quantum of equity that we invested in the early stages after the 5-year term, as per the requirements of Section 12J. The benefits, the deal onboarding cost is minimal because we are being fed opportunities on a monthly basis by the Auric accelerators. So that cost has been removed from Auric Capital. Behavioral assessments are in place. The intimacy of the relationship with Auric Business Accelerator and the individual entrepreneurs is profound and deep, and it's measured on a three times a month basis. Post-deal management is very active. We make a lot of our decisions driven by data rather than by stories, because when assessing growth momentum, you need to have data to indicate the scale behind the business, the current exercise of new growth in the marketplace itself, and the ability of the business's working capital to maintain it. We have a diversified portfolio. We invest in growth, we invest in exit, and we invest in behavior. And that makes us an opportunity to invest across sector, across industry, where we see those 4 elements in place. We're also migrating and moving into an environment in South Africa where over the next 3 to 5 years, the level of M&A activity from large businesses and corporate entities is going to increase. Such is the nature of a low-growth economy. Bigger businesses need to acquire growth rather than generate the growth themselves. And we are going to be exploiting that as a harvesting opportunity right across our portfolio. We manage clients very carefully. We collect 29 points of data, of which 15 points are financial. The rest all indicate the forward momentum of the business, the ability of the business to position and secure clients on a consistent basis, and then the capacity of the business to deliver, both through how the business is designed, plus the team performance itself. We look at trends in the business, and that starts to give us a sense of the growth momentum. And we invest on a tiered basis. For example, if a business is looking for 5 million rands worth of investment in equity, we price the equity, but we release the investment in stages as the business grows from one level to the next, hitting the milestones and targets that the business leadership team have put in place. And this immediately reduces what we refer to as our exposure to default in every single instance. 4 examples, this particular business established in 1998, 30 million rand turnover, family business. The sons have moved into the business. The youngest son is 34, the oldest son is 39. There's an enormous amount of energy coming into the business. They manufacture drums. A nice, dull, boring business that very few people want to get into, giving them extensive exposure into the market and entrenching them as a leading player. They're looking to raise funding to acquire a competitor up in the Gauteng region. And not only will that increase the number of drum sizes, bringing them into the retail paint market, but furthermore, it introduces a piece of technology that allows them to manufacture drums on sites. It's one of the key blocks in terms of servicing the agricultural and mining markets. And this will give them that distinct advantage, which will be unique to them. Another example of a business established in 95, on the smaller side at 16 million rand a year, founder-led with a view to exit in 5 years. This founder is one of the top 10 thought leaders in spectrometry, the science of light. And spectrometry is used extensively in big industry. With the advent of drones and the growth in the drone market, he is looking to raise funding in order to upgrade his manufacturing capability to make smaller spectrometers so that they can be located and sat onto drones. These drones are then used to evaluate the health and well-being of agricultural crops. They're used to evaluate the well-being of concrete structures such as bridges and water towers. It's a new element of growth in the market, and he is leading that at this point in time, but needs to rejig his manufacturing plant. This business, established 91, 25 odd million rand turnover, founder-led, again with the view to exit. In this instance, this individual sells a specific piece of software that X-rays big plant and equipment, much like you see on the screen over here. Before COVID, and in fact before 3 years ago, big companies typically would acquire the software, develop the skills internally, acquire all the hardware to maintain the software, and provide this as an in-source service across their own fleet or plant portfolio. Increasingly, with the low-growth economy in South Africa, big businesses are now trying to shed fixed costs, and they're outsourcing these capabilities. He has to transit his business from being a product-led sales business to a services business where he is securing 3 to 5 year contracts to provide that service on an outsourced basis. The last example is a dye manufacturer that, as a result of COVID, has seen the automotive industry and industrial industry turn around and say, no longer can we afford to have long, extensive supply chains. Localization of manufacture, especially in the leather industry and packaging industry, has become essential, and the rejig of their laser plants will bring down their dye-making costs by around 32%.
Pablo, thank you very much. So we are cut a bit for time, and I know that it's difficult to put a presentation together in such short time, but thank you very much.
Pleasure.
Great. Up next, we have Gaurav Anaya. Gaurav is one of the founders of Geltec. He's an actuary, and he's the CEO of Infinity Anchor Fund, and he was recently profiled in FA News as one of the top fund managers in the Section 12J market. His investment has done particularly well for consecutive years, but without taking the limelight away from Gaurav, let me hand over to him.
Thank you, Janti. Thank you very much for the introduction. I just wanted to go into a point which I think is quite important for context for the presentation. And that is something that Craig also mentioned, the use of the tax deduction in working out returns. And so there's this jargon that's used in the 12J industry, and I use it in my presentation, so I wanted to just explain it up front. So often there's the concept of gross capital and net capital. And gross capital is the money that an investor gives a fund. And net capital is the money they give the fund minus the tax deduction. So it's a smaller amount. And a lot of fund managers, we don't agree with this, but a lot of fund managers in the Section 12J space, they measure their returns on net capital. So that increases the returns. And that's taking into account the tax deduction when talking about performance, as Craig talked about. And they charge their fees after they've returned net capital instead of gross capital. So they have net performance fees, which then increases the fees. So we'll talk about our returns on a gross basis, but we also include the net basis. And that's because for comparison purposes, so that you can compare our results with the results of other fund managers out there, if you're considering anyone else. So today I'm here to talk to you about 2 investment options. The first is Infinity Performance. And Infinity Performance is a fund that we've been running for a number of years now. It was a top performing fund in its category in the 2019-2020 years. It's been tracking a return of almost 16% per annum. And this is on a net return, but you'll see the gross numbers coming. We had 100% of our capital invested in the last financial year. We've maintained a 6 monthly dividend payment track record. The last dividend was an annualized dividend of 5.2%. And we charge our performance fees on gross capital, so it's a low performance fee. This year, we're also coming to the market with a new investment option called Infinity Stable. And Infinity Stable was our answer to some people who were hesitant to invest in Section 12J or invest into the South African economy. And so it's designed around that. The investments have income that's underpinned by guarantees. There's a return of capital that is also guaranteed. It has a predictable exit profile, all leading to predictable returns. There's no performance fee given the guaranteed nature, the underlying guarantees, and we have a low minimum investment size. Now going into some of the details. So Infinity Anchor Fund Performance, we invest equity into asset rental businesses. Now, by their very nature, these businesses have a strong balance sheet full of assets and contractual regular cash flows. They also lend themselves to a clear exit strategy. They are able to either attract leverage to exit us, or there's the ability to sell the rental book or run the rental book off. We target investing 100% of the funds under management. This is as opposed to some Section 12J managers who only target investing 80% of funds. Now, 80% is the limit to be compliant. And so we think this is taking unnecessary and undue risk. And as I said before, we charge our performance fees on gross capital. I'd like to just highlight two investments that were noteworthy, just to give you a bit of a sense of the type of investments we make. Almost 2 years ago now, we invested into Secutec. It is a business that rents out security technology. So I'm talking about smart alarm systems, cameras, electric fencing, etc. And its customers are typically estates and body corporates or corporates, so not individuals. And what we've seen both before COVID and during COVID is we've seen a 0% default rate. And that, of course, is sensible because people don't want to compromise on security. It's a high priority. They don't want to default on a payment and have someone come in and rip out their alarm system, electric fencing, etc. It's achieving a return for us of about 9.73%, and that's excluding any of the tax benefits that the investor gets. Another investment we made which we made last year in June, is into Rise Telecoms. And Rise, in fact, is a business that owns and operates fiber infrastructure networks. And specifically, as you can imagine, during lockdown, demand for this went through the roof as people find themselves working from home, being at home more, wanting to watch Netflix, et cetera, et cetera. But what we've seen is that even post-lockdown, as people have come in and out of lockdown, that demand has not dropped. And in fact, that there's been virtually no churn. So it's not, I think it's a characteristic of high-speed internet that once you have it, you don't want to turn it off. You don't want to go back. It's also been providing returns of over 9% for us, excluding any tax benefits. Now, just to give you a sense of the pipeline. So what we did is when we went into COVID, when we went into last year, February, we had a pipeline of investments that we were ready to invest into. But with the advent of COVID, we actually went and threw out the entire pipeline and we rediligenced the pipeline, adding this extra criteria of it has to perform well in a COVID resilient way. And what this means is that it has to perform well before COVID and during COVID, because there was a lot of uncertainty in terms of, how many lockdowns are we going to go into? When will there be a vaccine? Now that we're in the period where vaccines coming out, we have a bit more certainty. But back then, we didn't know when it was going to happen. And so we wanted investments that could survive going in and out. And really, the only investment that survived that when we rediligenced our pipeline was Rise, which we invested into. But we've built up a brand new pipeline of investments that are COVID resilient. A few examples here across many different industries. The total pipeline is 17 companies. The amount is 250 to 550 million rand because they ask for a range usually. The average return, excluding the tax benefit, is between 10 to 25% to the fund. And most of this pipeline is exclusive to Infinity. Now, over here is just to talk a bit about performance. So Infinity has been returning on the 2019 class 4.94% as a dividend yield. This is on gross capital. On net capital, for comparison purposes, that's 8.99%. Our return on gross capital is 5.78%. When doing a projected IRR or return on net capital, again, for comparison purposes, that's 15.96%. And we already have 100% of our capital invested. When we compare this to some of our competitors, the reason that we've put this table in here is specifically because there's a shortage of information in the market. Not many 12J funds publicly report their performance. And so we've put a table up here for comparison purposes. So comparing to our largest competitor, you can see that Infinity's dividend yield is far exceeding that of our largest competitor. We're tracking an IRR of almost 16% on net capital compared to 10.8% for our largest competitor. We've seen a growth in net asset value. So one of our competitors, their net asset value has shrunk. So what this means that today the investment is worth less than at the point of investment. We charge our performance fees on gross capital, unlike our competitor. We had 100% of capital invested instead of sitting on a large balance of cash. Our dividends are paid out of profits only. So going back to the net asset value point, if your net asset value has shrunk, another way to interpret this is that some of the profit has been partially paid out of capital. but that's not the case with us. Our minimum investment size is a low amount of 200,000. And of course, we're happy to publicly report performance. Here's just a graph showing this graphically, and I think quite clearly displays the disparity in returns. This picture here shows on the left is the actual returns, and on the right is the projected returns. Interestingly, the projected returns is our projection according to us, and then our competitors' projection is according to them. And what you can see is during the actual period, their performance started to flag, and they project that forward. And over a period of time, this leads to up to 15% difference in value on gross capital. Now on to Infinity Performance. So Infinity Performance, really, this was an answer to hesitations around the performance of 12J funds. A lot of 12J funds have performed poorly. The question marks around how are we going to get exit and liquidity, is it going to be in 5 years, 6 years, 7 years, etc., and exposure to the South African economy. So what we've done is we've designed a fund that invests also into asset rental businesses. However, we're working with counterparties who have long track records and, most importantly, strong balance sheets. And what they do is, in the underlying investments, they guarantee us a minimum income stream, and they guarantee us exiting that investment after 5 years. So this leads to a predictable exit and hence overall predictable return for the investor. So just to talk you through some of the numbers, the returns are a bit lower than Infinity Performance, reflecting the lower level of risk. We look at a net dividend yield of 3.69%, a net IRR we're targeting of 10.95% per annum. Both of these are floating rates. We know we're in a low interest rate environment. So as interest rates go up, these will also go up. We have guaranteed earnings in the underlying investments and a guaranteed exit, and the ability with our counterparties to deploy 100% of the capital raised by March 2021. Now, we've put up a comparison here comparing Infinity's stable option to our largest competitor. And as you can see, our largest competitor doesn't have any of the risk mitigations that Infinity Stable has. And why this is important is that when you compare Stable's performance to that of our largest competitor, they're virtually indistinguishable. However, Stable has much more risk mitigation in it and a predictable exit. This is just comparing Infinity to cash returns. But I see John T there. My time's running out. So thank you very much for listening to my presentation.
Carl, thank you very much. If you could unshare. I see I have about 4 minutes to present the last fund, and I think that's more than enough time. So the last fund from Geltec is Zimbali Capital. Zimbali Capital is a property-backed Section 12J fund. We invest into student accommodation and to the leisure industry, hotels. A key offering in this fund is that the companies or properties in which we invest come with a guaranteed exit of half of our investment. So what this means is after the 5-year term, if we invest into a hotel and we're struggling to sell the hotel, Zimbali or its group will buy out half of our investment at a price which will guarantee the investor a 6% return on their gross capital and around a 14% return if you include the tax benefit. In terms of investments that we've made, the first two are very important because those are the two investments that we're going to invest additional capital into. So the first is Reza. Reza is student accommodation around 1 kilometer away from the university in Stellenbosch. It's an asset that's done really well for us. As you can see, just under 10% as a return to the fund. That assumes a property growth of 6%. We've invested just under 13 million rand into this property. We invested into Dezelza Lodge, and Dezelza Lodge came with a guaranteed return as well as exit, and I'll speak you through that in a moment. But this is a 4-star hotel. It's on the Dezelza golf course, and it's run by subsidiaries within the Zimbali group. And then we invested in a new development that's being constructed as part of the greater Zimbali estate, but construction will only be done at the end of next year. In terms of return, the fund has done really well, particularly in the property sector. The average dividend yield for our investors, if you ignore the tax benefit, is 4.1%. The IRR in this fund, if you ignore the tax benefit, is 8%. There's an assumed property growth of 6%. If you want to take the tax benefit into account, the dividend yield is 7.5%, and the IRR is 14.6%. That assumes an investor in the highest tax bracket. And amazingly, in this fund, every single year within a couple of months, we've invested 100% of our capital. And that's really because of our relationship with Zimbabwe and the enormous amounts of properties that they manage. If we do a comparison with our largest competitor in the student accommodation space, you'll see the top line is Zimbabwe, the bottom line is a competitor. The middle line separates actual to the left and projected to the right. This is based on our fund fact sheets and on their fund fact sheets, so we haven't made up these numbers. And as you can see from the graph, we're doing particularly well. Similarly, in the hospitality sector comparison, our competitors' fund is a lot older than ours, but and it's reached maturity. And if you do a comparison, you'll see that our fund is doing really well. This year, we are capping, and I see I have 1 minute left. We're capping our investments to 35 million rand. We're investing 24 million into the Zelza Lodge. There's an underlying guarantee which will give us a yield of 5% in year one, growing to 9% in the final year. Half of our investment will have a guaranteed exit. And if we take property growth into account of 6%, this investment will give our fund a return of around 8%. The remaining 11 million rand will be invested into the Zelza Lodge. It's an asset that's been in our portfolio for a number of years. It's currently producing a yield of around 7%, which is really good, has really not been affected by COVID. And there's a guaranteed buyback of half of our investment. This investment will give us a return of, or the fund a return of around 9.5%, assuming a property growth of 6%. I think I've now run out of time. All our funds have a minimum investment of 200,000 rand for the first investment, and then 100,000 rand in can be spread across the funds as you wish. Craig?
Great, thanks.
Apologies.
Thank you, John T. Now we appreciate the effort to stick to time. And yeah, 30 minutes is you can get a lot in, but you can also run out of time very quickly. But we appreciate it. I don't know if you guys are going to stick around. We're going to go into the next presentation from Westbrook, and we're going to take questions afterwards because there is a risk that Q&A can take us quite deep into the next presentation time.
I will definitely stick around. If Gaurav and Pavlo can, they will. Otherwise, I'm pretty confident I can answer their questions.
Great stuff. Thank you, guys. We appreciate that. At this point, we're going to hand over to Westbrook. I don't know if Dino or Janti will be coming up. It looks like Dino. Thank you again for your time and for joining us. And we are looking forward to your presentation.
Thanks, Craig, and good afternoon to everyone who's dialed in. We've done a few of these, and I know that for a client dialed into a webinar, it can be a heck of a lot of information in a very short space of time. So for those of you who have more questions, please feel free to ask at the end or to get hold of us afterwards. We'll also do our best to keep what we explained to you today simple and easy to understand. By way of background and introduction, my name is Dino Zakolo. I'm joined today by my colleague, John T. Osher. John T. and I are the co-heads of the Section 12J business at Westbrook. I'm also the independently elected chairman of the Section 12J industry body of South Africa, which we co-founded a couple of years ago. I suppose really there the focus is on leading the effort of engaging with National Treasury, SARS and Parliament regarding the future of Section 12J and the potential for an extension. I'll touch on that in a little bit of detail in a bit. I think maybe just as a point to start, we've seen this throughout South Africa, and it's not just true of 12J, but it's true of investing as a whole, which is that you hear great stories from a lot of people when it comes to your investments, but the proof is only in the pudding, and the pudding is only eaten when you get your money back at the end of the day. So, in our view, what is as important as the underlying investments themselves is who you're investing with. And so maybe what I'll do by way of background is just explain who we are as a group. So we're a business by the name of Westbrook. The Westbrook Group was founded in 2004, a number of years ago, by two individuals who are still the chairman and the CEO of our business today. And the third individual, who's a material equity holder in our business, is the Capricorn Capital Group. Capricorn are an investment vehicle of a reclusive billionaire family by the name of the Einthovens. The Einthovens own a number of companies that you'll probably know the names of. They are the Hollard Insurance Group of companies. They are Nando's. They are the And Beyond Hotel Group, the Spear Wine Farm down in the Western Cape, and so on. So really a business that was founded by very well-known and established individuals in the South African investment ecosystem, initially with a view to investing private equity investments using their own money. Westbrook today owns a number of assets using our own capital only and not that of third-party clients. Those include the Corrie Craft Group, as an example, which owns Corrie Craft. It's got Volpes, it's got Dial-A-Bed, etc. So I suppose as a way of background, we are, and we're proud to be, a business that has across South Africa, the UK, and the USA more than 6 billion rand of assets under management on behalf of more than 1,000 clients. And importantly, we are owned and managed and run by individuals of repute in the South African investment ecosystem. And for us, this is absolutely fundamental, because it's one thing, obviously, to give your money to someone and hope that they do well, but it's another to get it back, and we'll touch on that. And obviously, by investing with people that are well-known and that have reputations to uphold, it is a good way of protecting yourself from a risk perspective. What do we do as a business? We're an alternative asset manager as well as an on-balance sheet private equity investor. We invest money on behalf of ultra-high net worth and clients and wealth managers around various products around the world. And what we've got up on the screen now is just an explanation of some of the things that we invest into. Those include private debt in both South Africa and London. And we have a hybrid capital business, which invests across South Africa and the UK. We do direct real estate investing. This is in South Africa, in the United States, and in the UK, and private equity venture capital through various jurisdictions around the world. Not only are we an alternative asset manager, but we're also a very well-established Section 12J investment business. We are very proud to be, by a long way, the largest Section 12J manager in South Africa. We manage more than 2.7 billion rand in Section 12J assets under management, which we've raised over a number of years and across a multitude of different investment strategies. More important than how much we've raised is what we've done with it. We've invested more than 1.4 billion rand of third-party client capital across more than 60 SMMEs around South Africa, which again is a number far in excess of any competitor in the market. And that for us really is a demonstration of our ability to invest and successfully invest capital at scale. I spoke earlier around sort of the proof being in the pudding, and that for me is something that I can't impress upon enough. It's always nice at the beginning of these Gradidge presentations to see Craig put up the slide of a client's investment and to see how well it's done with us since inception. And we're really proud in that vein to be, to my knowledge, the only Section 12J company in South Africa that is not just talking about how good our returns are, but that is actually successfully exiting clients in cash as we speak. Our earliest vintage of the Auric fund, which Jonty from Westbrook will take you through in a bit, is currently in the process of giving clients their money back because the 5-year investment period has successfully exited. And that's at a 14% annualized return, taking into account, of course, that in 2016, the tax rate applicable to individuals was only 41%. So there was a smaller tax saving back in the day. Through COVID, our funds across the board, and there's obviously many of them, remained resilient and continued to pay dividends to clients, which to us is testament to the fact that we've made what we believe to be good investments. Not only do we have a lot of client money that we invest, but something that we think makes us absolutely fundamentally different is that we are a significant investor in everything that we put our third-party clients into. For example, our 12J business and businesses have more than 100 million rand of our own group capital, be it from ourselves as shareholders and management in the business, as well as the larger group as a whole. And for us, there's absolutely no way to better promote alignment and to keep your manager honest than to ensure that they have their own money sitting directly next to that of yours. As I mentioned, we also the co-founder and chair of the 12J Association of South Africa, just to give you a little bit of background to the Westbrook business. I'm not going to talk you through in detail sort of the 12J legislation. Craig did that much better than what we could at the beginning. But what I will do is just give you a very brief update on Section 12J and a unique perspective, I suppose, having been the person sitting in front of Treasury and Parliament over the last few years. So when 12J was introduced in 2009, there was always what's called a sunset clause. And that means that at a point in time, 12J ends. Treasury always do these things with incentives because what they want to do is when they bring them in, they want to make sure that at a point in time, they're able to end them and then have a think around whether the incentive is achieving the things that it's supposed to. Now, that sunset comes in June of this year. And so obviously very topical at the moment is the conversation with Treasury and Parliament around whether Section 12J should or should not be extended. I have been involved in various engagement processes with both National Treasury and Parliament over the last few years, the most recent of which was earlier this year around a survey that Section 12J, the industry was sent by National Treasury, where they were looking for more information to try and understand what we've done as an industry. I'm not going to bore you with the details of where National Treasury are at from their, in terms of their mindset around 12J. But what I will say is that it is probably 50-50 in my view as to whether or not Section 12J will be extended. There are very strong arguments as to why it should be extended. That includes the fact that we've created a lot of jobs and we've done a lot of good in the South African economy. But there are also things that National Treasury are unhappy with. And mainly these issues center around risk. 12J was always something in their mind that was supposed to include risk. And something that's made them unhappy of late is the fact that many Section 12J offerings are devoid of risk and the underlying investments are not risky. And obviously their concept of giving a tax deduction in that context is not something that makes them happy. What I will say is that by the budget speech at the end of February, we'll probably have a better idea of what the future holds for Section 12J. And this is important to point out. Irrespective of what happens around the future of Section 12J, if you invest before the end of June, so effectively before February, if you want it for the 2021 tax year, and before June, if you would like your deduction to be in the 2022 tax year, you are safe from a tax perspective. SARS cannot make these changes retrospectively. If they were to cancel 12J, they would do it on a prospective basis, i.e. they would stop things happening going forward. I think the risk to a Section 12J investor to consider is that if 12J is cancelled, and as a result, many of the managers out there that run 12J businesses are no longer able to raise new money, what's going to happen is that their assets under management are going to slowly decline. And the question I would ask myself is if 12J doesn't get extended, who's going to be around in 3, 4, and 5 years' time to manage the Section 12J investment that you've made and to make sure that they're actually going to exit it to the best of their ability. And so whilst there isn't a tax risk to the 12J sunset clause, there's very much a manager risk and the commercial risk around making the investment that we would suggest that you consider. That being said, I think at this point, what we should maybe touch on very briefly is just our core investment principles. And those principles really are what we believe have allowed us to solidify our position in the market. Number one, our first and foremost goal is to make sure that we secure your tax break. Because frankly, in our view, the tax break is something that you see as being hugely important for making this investment. And what isn't often focused on is that there's a whole lot of things that can go wrong that can negate that tax break if your manager doesn't ensure the compliance is made and looked after appropriately. The second thing that we do is we focus on capital preservation. Frankly, from our perspective, the tax break is important and it's a fundamental part of your return. I would argue that many 12J investors, had it not been for the attractiveness of the tax break, wouldn't have been thinking about 12J at all beforehand. That isn't to say that you mustn't make a good investment. You must absolutely make a good underlying investment. But frankly, because of the fact that the tax break gives you such an attractive return, we can go as a manager and focus on capital preservation. In other words, not taking huge risk and not chasing big returns, but on a blended, we can still give you a great annualized overall return. That's our third investment principle, is to give you an attractive risk-adjusted return, i.e. the return you get should be higher than the level of risk that you're taking. And the fourth is the exit, which is always important when you're making investments into small and medium-sized businesses. That being said, let's focus very briefly on the two funds that we're offering this year for investments. They are our two flagship strategies. The first, John T., my colleague, will take you through. It's Westbrook Aria, which is the largest Section 12J investment strategy in South Africa. And then I'll take you through Westbrook Stack, which is our other flagship, which is an 800 million rand student accommodation investment strategy. And the two form a suite of products that we're offering to clients this year. Many clients choose one or two, and some even choose to split in predetermined ratios between them. With that said, John T., I'll hand over to you for a bit.
Thanks, Dino, and thank you everyone for your time and listening in. It's great to have you in this new digital format. I think obviously, so Westbrook Aria, Dino alluded to, is a strategy that invests in rental businesses. And with that in mind, I think the easiest way to understand it is always just to use an example and show you an asset. So we'll play you a video of some of the underlying businesses that we've invested in to give you a sense of what we've done there.
I started Curafin in 2003, ironically here at UPD, was my first customer. Curafin in essence is a company that creates or provides the skill to an owner-driver, a skill that he may not necessarily have. We do end-to-end processing for him, from his payroll to his invoicing to his creditor debtor payments, obtaining finance, fleet management, fuel management tools. Owner-driver's been around for quite a while. It sort of links into the broad-based Black Economic Empowerment codes of late. A lot of corporate companies are moving away from employing drivers to creating little micro-entities, as we've seen this morning at UPD. Each one of the little micro-entities has an owner, the owner-driver. He contracts directly with UPD, and in turn he will employ 3 to 5 people as drivers underneath him, hence the job creation. In order to get funding for a small medium entity like that is incredibly difficult at the main banks. The business sort of stagnated between 2006 for 10 odd years. We sort of kept the same sort of customer base and just ticked along. With the injection of the capital from Westbrook Aria, we've been able to go out and grow and gain more customers.
So that's just one of the videos we have of our underlying investee companies. We've got a lot more detail around our investee companies and the assets we have, but obviously time constraints stop us from playing the full video. So let's kick off into what Westbrook Aria is. So as Dino mentioned, Westbrook Aria is one of our flagship funds. It's been running since 2015. So it's been running since Westbrook started investing in 12J when the legislation became more favorable in 2015. So we've got a long track record of performance data, underlying partnerships, and how we exited, to what Dino spoke to earlier. One thing I just wanted to allude to before I get into the detail of Westbrook Aria is how we actually run our Section 12J funds. So we term each year that we raise, and we raise to the tax year, being the end of February, a vintage. So for example, we have our 2016 vintage, our 2017 vintage, our 2018, 2019, 2020. This year we'll be raising for our 2021 vintage. What's important about that is we run each vintage in its own ring-fence Section 12J company, selected just for those investors that invest in that year and have its own underlying portfolio of asset rental businesses. Why do we do this ring-fencing or closed-ended funds, as it's also known? I think there's 3 main reasons why we do this and raise each new fundraise into a new fund within the same strategy and mandate, but a new fund. I think the first reason is on entry, if we're bringing an investor into existing portfolio, a value of that portfolio has to be determined. And in determining that value, someone's got to, whether it be the investment team, an independent third party, has to provide a valuation on the NAV that brings in an investor. Now, that could prejudice either the investor who's already in the fund or the investor coming in if that value is slightly off. So we don't like any entry valuation prejudice. So one reason why. The second reason why is probably the most important reason in our eyes is that an investor who comes into a fund in 2016, for example, and one who comes into a fund, say, one of our 2018 investors, their 5-year period starts at different times. So in order to create liquidity for the 2016 investor, you'll either have to liquidate or sell the portfolio at a point in time that might be prejudicial to the 2018 investor. So therefore, by them investing in their own portfolio, where all 2018 investors are in one portfolio, it takes away that prejudice. I think the third thing, which is more compliance requirements of 12Js. 12J says from the day a venture capital company or 12J company first issues a share, it's got 48 months to invest at least 80% of the capital that it has raised. Now, if you're running a perpetual vehicle and you keep bringing capital in, each year that 48 months gets closer and closer, and actually provides a prejudice to the later investors, because they might only have a year in some cases for that fund manager to be able to invest that capital, which might make the fund manager invest in assets that particularly would not meet the mandate, but more wanting to meet the compliance requirements. So we believe by running the close-ended vintages into the year of the investment gets away from those risk profiles. Westbrook Aria, its very nature, is a fund that invests capital into rental businesses. The core to the strategy and what makes us different is, I think, we partner with established, reputable operators with alignment of risk. I think this is fundamental to our approach to investing, is that our partners in these rental businesses put in capital alongside our investors. So let's do this by way of an example. You saw on the screen, we put up a UPD owner-driver rental business. Essentially, our partner there puts in 20% of the capital to buy a vehicle, and we put in 80%. What is important about that is if anything ever goes wrong in the underlying rental deal, and we have to take that vehicle back and can only sell it for 90 Rand, our investors get the 80 Rand capital back first. So it sits as preference to our partner's capital, or our partner's capital, as we term it, sits as first loss. That, in a risk mitigation environment, is very, very valuable, because any losses will eat into our partner's capital before it does our clients. We invest in a portfolio of tangible asset-backed rental businesses where the assets have a value, but more importantly, there's a contractual revenue stream attached to that asset. So what does that mean? It means we know on day one how our clients are going to get the return and how they're going to get their capital back from the rental of that asset. What we've seen historically with our performance, we've obviously running about R1 billion portfolio in Aria, is that during COVID, partnering with the right partners with that first loss component has meant that our targeted returns are still being met. We paid dividends during the COVID period, and most importantly, we haven't lost any investor capital. So I think the robustness of the investment strategy over a long period of time, 5 years now, has proven that what we are targeting at the investment level, the deal risk that we're targeting, we believe is appropriate, and then enhanced with the tax kicker gives you that risk-adjusted return. What is very key, and I think Craig mentioned it in his opening on 12J, is obviously there are many different asset classes that you can invest in through a 12J incentive. But obviously exit is one of the most important. How does an investor get their capital back after 5 years? And what we've seen with our Aria strategies, we manage the portfolio in what we term a self-liquidating nature. So what does that mean? That means we provide the capital to these rental businesses, but at a point in time, we stop deploying new capital, and we essentially collect all the rentals back over a period of time. And over that period of time, which usually times to our 5 years, we've actually collected back all the return that we need for our investors, as well as the capital that we need to exit our investors at year 5. So Dino alluded to it. Our 2016 vintage of investors is now exiting in March 2021. We have all the capital to create that liquidity at the 5-year period, and an IRR of 14%, including your tax benefit, but after taking into account CGT, we think in an environment of COVID is a very, very attractive return. So to touch on what we're targeting for Aria this year, we're targeting a return of an IRR of anywhere between 12 to 15%. Again, given the nature of our underlying investments, we are correlated to the movement in prime interest rates. So therefore, we provide a band. That is true on our dividends as well. So we're targeting a dividend on your gross investment of anywhere between 3.5% to 5%. If you equate that to your net investment or your net risk capital, that's anywhere between 6 to 9%, and that is payable semi-annually. I think this is just how our returns are achieved over a period of time. Aria is obviously designed as a strategy to pay cash yield during the period and is not looking for capital growth. So we are targeting an IRR of 12% after all fees and including your exit CGT. So that would be after your exit capital gains tax. On the screen, I've just put some examples of what we've invested in to date. We have over 35 partners in this space, and we've leveraged off the knowledge that we've learned by being on the ground and investing in these assets on who the right partners are, what the right industries to target are. And fundamental to our strategy in the softening interest rate environment is not to target deals that achieve a higher yield to chase returns, but in line with our core principles is to focus on capital preservation, achieve a good yield in a market-related risk investment, but then enhance that with your 12J tax benefit. So since, in a very similar vein to many investors out there, when COVID hit in call it March last year and the hard lockdown came into being and then some uncertainty post that, we put across all our investments a capital investment moratorium. But since October, we have been confident to re-enter the market and have actually invested about 150 million rand of capital into ARIA deals. So from a pipeline perspective, we are seeing a solid pipeline of investments. We're executing on a few more investments as we speak. And the 2020 fundraise, the capital will be used to execute on the pipeline in the targeted time frame of 18 months. So in all our strategies, we target to invest the capital within 18 months. We believe following a conservative approach to investing and taking time in the market to find the right opportunities is optimal and key to the capital protection mechanisms that we put in place.
Thanks, John T. So I think the next thing I'll do very briefly is just talk you through the second strategy which we're offering this year, which is our student accommodation fund. And it's a little bit easier to explain than ARIA, but it is equally as attractive. So what is student accommodation at Westbrook? It is a partnership between ourselves as the 12J Fund and high-quality student accommodation operators around South Africa, where we invest alongside our partners in some of their assets around the country. And I think a great way, again, to demonstrate this to you is to show you some of the investments that we've made to date.
Campus Key started approximately 10 years ago. We've got 4,000 students in our community, and we're the premier luxury student accommodation provider in South Africa. Our model is that we must be close to campus, and we have started out, as I said, 10 years ago with one building in Stellenbosch, which was 60 beds, and we've grown from strength to strength. And now we have 35 buildings at 6 of the main universities in South Africa. Campus Key is not only about buildings, it's about the student, it's all about the student's well-being, and we've grown from a property manager and a developer to a manager who looks after the student's well-being. So we've got mentor programs, social responsibility programs, student life skill programs for all our students. And therefore, Campus Key is an all-inclusive student service provider. Our relationship and partnership with Westbrook allows us to focus on what we do and what we really do well, and that is to look after the students and not to worry about our funding facilities and to worry about our investors. We've entered into agreement with 3 of our state-of-the-art buildings with Westbrook. The first one is a 585-bed single occupancy state-of-the-art facility in Rosebank, Cape Town. The second one is a 160-bed state-of-the-art facility in Pretoria. And the third one is a 306-bed state-of-the-art facility in Port Elizabeth. We're not only a student service provider, but we're concerned about the well-being of our students. We realize that Westbrook share the same values as we do. And being an investor, we, after a number of discussions, realized that Westbrook would be a benefit and a good partner to us, and we decided to proceed with the Westbrook investment.
So I think what you see there is a good example of the types of things that we invest into in our student accommodation fund. Maybe just very briefly, the nice thing about student accommodation is that it was probably the most resilient property class of any property class in South Africa during COVID-19. And I say most probably because it was with the exception of maybe logistics and last mile logistics assets, which obviously benefited a lot from the theme of take a lot and online shopping. But why was student accommodation so resilient? Well, student accommodation is subject to one of the largest supply and demand imbalances in any property class in South Africa. Statistically, there are 300,000 too few student beds around the country. As you can see on the screen, from a numbers and a statistical perspective, where, for example, UCT in Cape Town has 28,600 students, there are only 6,700 on-campus beds at UCT and approximately double in each of these off-campus. It's even worse in other universities. Take, for example, WITS on the left-hand side. They have 40,000 students, 8,000 on-campus beds. UJ, 51,000 students versus 6,600 on-campus beds. And really, what this does is it drives an industry where your occupancies are close to 100% on an annual basis. And the thing about students is that universities in South Africa aren't going anywhere, irrespective of whether COVID-19 is there or not. I think one thing that is key is to understand what COVID-19 has meant for student accommodation. Although universities have had to try and move to some form of an online model during COVID-19, it's become very clear to everyone that they cannot do this equitably and they cannot do this on a sustainable basis. Most of the academic years won't even finish last year. And so really our view around student accommodation is that whilst universities going forward might adopt a hybrid online and in-person learning model, the only way they can effectively do it is to do both. That's not only the case because it would be unfair to go online only, because inherently wealthier students who have access to IT, high-speed internet, and conducive learning environments would benefit, and those poorer students would fall away and would clearly not have the benefits of such facilities. But it's more than just about, which students are able to learn online and which aren't. I'm sure all of you have kids, and for those of you who haven't had yet kids or have chosen not to have kids, were 18 once before. And I can tell you that when I was 18, one of the reasons I went to university wasn't just so that I could go and learn. It was so that I could get out of the home. It was so that I could become an adult. And it was so that I could do the kinds of things that adults do, even though I had only just turned 18. And that is very much the case throughout student accommodation globally. Students don't want to just move into student accommodation because they want to learn. They want to move and become adults. And parents, conversely, want to ensure that their students and their kids have safe places to go and learn. And so really, student accommodation from our perspective is a heck of a robust investment. What does this mean for you from a Section 12J perspective? Well, the Westbrook Stack Preferred Fund is an exclusive partnership between Westbrook and premium student accommodation operators around South Africa, the largest of whom currently is expected to be Campus Key, which we just showed you on that video. The investment targets to pay you a 15% annualized return that takes into account the tax benefit, and it takes into account all taxes at your level as an investor. And it also pays a dividend every 6 months. And that annual return is about 4% based on your gross investment and just over 7% if you take into account the tax saving. I think the other reason that we really like student accommodation is not just because we think that it is a heck of a robust asset class that did really well during COVID, which is arguably the black swan event of the century, but it's also a property. And it's not just a property, it's a well-located property, which is typically in an area close to where people want to stay. For example, in Cape Town, it's typically in Claremont and surrounds. In Stellenbosch, it's in the town. And so if everything else goes wrong, you still have a bricks and mortar asset in a good location that underpins the value of your investment. And that can easily be converted into the likes of residential apartments, as an example. And that's an option for us to exit should everything else fall away and fall apart, which we think is highly unlikely at this point in time. Just to show you very quickly the return profile up on the screen, you'll see that the 15% IRR is achieved using the profile or following the profile that we've put up there. You'll notice that the dividend yield starts off a little bit lower. That's because we've modeled in a slightly lower return in years 1 and 2 because we want to keep cash buffers in the entity to protect against any eventualities as a result of COVID. And that ends, obviously, with you getting a nice capital appreciation kicker on exit. So Craig, I think in summary, from a Westbrook perspective, there's 2 offerings this year. It's our 2 flagships, Aria and Student Accommodation, or STAC. We are limiting the raise, but obviously the Gradidge relationship runs deep and runs long, and we'll make sure that your clients are looked after. And thank you everyone for staying so long and for taking the time to listen to us this afternoon.
Great, thank you, Dino, and I think thank you to Jonty as well. And yeah, to our clients who've stayed on, and I see that most people have stayed on. I think that's testimony to both presentations being quite informative, very useful, and quite interesting. What we want to do now is open for questions. I see there are 2 questions in the Q&A box at the bottom that have arrived, so I will ask those questions in a minute. I just want to let you know that we are recording the session, and we will send you the link to the recording, to the video. So if you do need to run, you would be able to log back on and have a look at the questions. So yes, you guessed it. The answer is the presentations will definitely be shared. So I've got the presentations. We'll send them out in PDF format, just to be safe. And then the videos will be, we will send the link to the YouTube channel for the videos. So a question, I'll put this to you, Dino, and then maybe Jonty Sachs at Jaltec can also answer. Both questions that have come in so far asking about the impact of COVID, in particular on student accommodation. The one comment is that they're hearing horrific stories on the ground. I don't know which grounds those are, but they're hearing these stories. And then the other one was my nephew, a VIT student, and all of his friends who were in a student accommodation have returned home and are doing their degrees from home. So how does this impact the investment thesis, Dino, and then Jonty after that?
Yeah, Craig, it's been fascinating to watch. And for so many years, people have spoken around student accommodation being this defensive asset class. And, you know, it always requires something like COVID for that to be truly tested. I think it's fair to say that no industry has been totally immune from COVID, you know, either good or bad. And student accommodation isn't an exception to that. To understand how it's performed, I would split it into its 2 constituent parts. So you get 2 types of students. You get a student who is NSFAS funded. That's the government effectively paying for that student. And then you get a student who's banked by, you know, what we like to refer to as the bank of mom and dad, which is interesting because there's research that shows that, you know, parents are prepared to spend things like twice their annual income on their kids to make sure that they're looked after properly. So from a government perspective, NSFAS has been amazing during COVID. Government were very clear that at some point students need to go back, and when they go back, they have to have a place to stay. And so in our facilities that were funded by NSFAS, we've continued to receive our income in full. We did have a bit of an issue last year from an arrears perspective. So what happened is the way NSFAS is administered, and it depends on the university, NSFAS pays the university and the university pays us as the student accommodation provider. What happened last year is that some of the universities closed and their finance departments obviously worked from home or weren't working. And so we had difficulty collecting payments from certain universities, but those arrears have all been worked out. And I mean, if I was to look at our NSFAS facilities, our Stellenbosch facility, which is fully NSFAS, is full this year. The university hasn't even opened yet. Our Durenfontein, Braamfontein portfolio is about 80% full, and those universities are only opening on the 15th of March. And typically the way NSFAS works is that obviously students will only pick the student accommodation close to the time when they come to the facility. From a private student perspective, it's a little bit different because here you have thousands of parents, and parents have different views around what Johnny should do. Now, on the one hand, parents have signed 12-month lease agreements, and so they are contractually required to make payments. There was a whole discussion last year when COVID happened around force majeure and whether force majeure can or can't be called and so on. But the nice thing with student accommodation is because the leases are only 12 months or 10 months in some instances, you can quickly change those contracts to the extent there's an issue. on the portfolio from a private side, we gave some parents discounts for the months that their students weren't available or able to stay in the facilities, but that was in the minority, and our fund, because of the way we structured the transactions, was actually totally unaffected by that. Again, the proof is in the pudding, and if you were to look at a partner of ours like Campus Key, on the basis of lease up, the assets we own are full from a bookings and applications perspective. So the question around WITS is a good one, but you've got to understand that the dynamics run far deeper at each university than simply looking at it at face value. For example, WITS and UJ are universities that predominantly actually attract a poorer NSFAS-funded student. Most of those students don't have the luxury of going and learning from home. They have to come to university because they don't have high-speed internet. They don't often have internet facilities, computers, and a conducive studying environment. So they actually have to come to student accommodation to learn, and all students need to be close to university to write tests. In other regions, for example, Stellenbosch or Cape Town, where you've got a slightly higher, more affluent student, it's more the theme of kids wanting to get away from home. And again, the proof is in the pudding, which is that we're full. And so we're actually very comfortable with the investments. I'd also just say that these are 5-year funds. And whilst the theme of online in a country like South Africa may permeate and become more and more a theme in the next, 20, 30 years, once many of the issues that we face as a country have been resolved, it's not even a big theme in the US statistically yet. And so we've got a long way to go before we get close to that, in my view.
Great, thanks for that. Do you know, Jonty, and if you want to add anything to that, Jonty?
Yeah, I think just, Craig, just a couple of lines from our side. Obviously, in student accommodation, the business model or a successful business model is really dependent on location. Location. And I think what we're seeing is there is a significant portion of students who won't be returning to university. They'll be doing, and I'm sure some of your clients are experiencing this now with kids who are living away from home, is that a portion will continue online and will probably be staying at home. But those that do return to university, location is key. The further you are from the university, occupancy levels are going to be significantly lower. So it's key to be invested in nodes that are in very close proximity. From our fund's perspective, the accommodation is very close to university. It's at 100% occupancy for many years. But as a fund, we're not overexposed to student accommodation. It's a mixture of student accommodation and leisure. And we have an underpin guarantee. So our investors have a safety net. And we've got 2 years of track record in this investment. So we're very comfortable. So I think it's going to be a mixed bag. I think if you're overexposed to student accommodation and the accommodation is far from the university, I think those assets are going to do poorly.
Great, thank you, Jonty. Jonty, if you could just stay on and answer the next question. We got a question from Yugestra. Is the tax benefit in the form of a refund from SARS? So if you earned 1 million Rand and your effective tax rate is 45%, had you invested 450K this year, you will get a tax refund of 450K in this tax year. Yeah, so I think what people make the mistake, and I think it's as a result of Section 12J marketing, is you only get a 45% refund if the portion that you invest is above the 45% tax bracket. So a simple example, if I have 3 million Rand of taxable income, in other words, I've had a look at all my deductions and my taxable income number is 3 million. If I invest R1 million, I'll get a refund of 450,000 Rand. If I'm a provisional taxpayer, I'll pay 450,000 Rand less in tax. The key difference here is a provisional taxpayer gets the immediate benefit, where a PAYE payer who's already paid the tax will have to wait a couple of months after they've submitted they'll submit the e-filing, wait a few weeks, and then get their refund. Yeah. So,
Craig, there's something maybe I can just jump in there. From a Westbrook perspective on our ARIA offering, we obviously have been supported by PAYE taxpayers in the past. So we have quite an innovative solution, which is a PAYE bridge. Essentially allows the investor to give us their 55 Rand today and only pay the 45 in 11 months' time once they've gone through the process of getting their refund. So if any clients want more detail on that, be happy to share that.
Right. Thanks for that, Jonty. I don't see any other questions. If you do have a question that you would like to ask, maybe raise your hand or kind of put it in the chat. Then I can unmute you and allow you to talk. So then if there's anybody there who would like to ask a question.
Craig, maybe if I could touch on a couple of things while people are thinking of questions. Often question that comes up is, what happens if I immigrate during or financially immigrate during the investment term, or if I pass away? So under those scenarios, the tax benefit, if that happens or if that occurs during the 5-year investment term, you lose the tax benefit. And you'll simply have to pay back the tax benefit to SARS. In the circumstance of death, your estate will then have to pay back the tax benefit, but this is without any interest or penalties. So it's just something for investors to know. If you're very senior in age, this might not be the right investment for you. If you're looking to immigrate shortly, this might not be the investment for you. So yeah, those are just a couple of things to consider.
Yeah. Thank you for that, Jonty. It's very useful information. Okay, so I see we don't have any more questions coming through. Allow me to take the opportunity to thank you all for attending today. We appreciate the time. To the teams from Westbrook and Jaltec, thank you very much for those informative sessions and for availing yourselves. We know it's late. We know you guys are busy, especially during February. To our clients, we will be sending out a note on retirement annuities and tax-free savings accounts either tomorrow or Monday. So just to remind you on the deadlines for those. But thank you for your time, and we look forward to seeing you guys all again sometime soon. Take care and goodbye. Cheers, everybody.